Actively managed mutual funds have faced a great deal of competition from index funds, and now they have additional challenges from a rising rate environment and from new market volatility. So we asked one of the leaders of a fast-growing top mutual fund brand that's actively managed, George Gatch from JP Morgan Funds, to talk to us about what he sees as the major challenges for his business going forward.
First and foremost, as an active manager, strong investment performance has been the driver around the growth of our mutual fund business. We have outstanding investment performance. More than 80% of our funds outperform the median fund over a 5-year period of time. And I think what's particularly important is the breadth of the performance across asset classes, particularly strong performance in our U.S. equity capabilities, our fixed income and absolute return fixed income offering, and in our multi-asset class capability, which has been an area which has been a growing part of what investors demand from us, both in our target date series as well as our income-oriented funds. So investment performance has been the key driver of our growth and success. But also we have put a lot of emphasis in working with advisors to help them manage through volatility. And I know that it may not seem obvious, but in fact volatility has been quite helpful to us and our growth, because it's been an opportunity for us to engage advisors and to help them work with their clients to manage through volatility. So as an example of this, through the recent volatility in August, we responded very rapidly as the market volatility increased. We had calls immediately the same days as we see market adjustments, and send out notices and information to hundreds of thousands of financial advisors in the U.S. We also, our Dr. David Kelly and Market Insights program has been particularly focused on very quickly responding to advisors who have the challenge of helping their clients stay the course during market volatility. And I think it's been one of the hallmarks of what we've done through the financial crisis in 2008 and 2009, and through periods of market volatility. And it's allowed advisors to rely on us to help them manage their businesses. I think, frankly, since the financial crisis, that has been a game changer for firms like us, because even though returns have been quite attractive, all-time highs in the equity markets, all-time low in rates in the fixed income market, it has been a challenging period of time, and helping investors stay the course so they can get the benefit of a long-term investment strategy, I think, is the critical foundation of what we have to do as helping individual investors stay the course over the long term. And I think going forward, it's going to be even more challenging than it has, simply because it's unlikely we're going to be able to achieve the same level of returns that we have over the past 5 to 7 years, and likely to have more volatility as the Federal Reserve tightens monetary policy. So I think it's even more important going forward than it has been in the past. And I think firms like JP Morgan are very well equipped to help advisors confront the challenges that are coming. Since the financial crisis, there's been a tidal wave of regulation in the industry, and it's one of those key things that we as a asset manager have to be incredibly aware of, and helping our clients manage through what is going to be a harder period of time to be able to help investors. So our focus as it relates to regulations will allow us to continue to provide the value that we have to investors in the future as we have in the past. And the key thing for us is to ensure that investors, through the Department of Labor's likely changes to the fiduciary rules, is to make sure that those rules don't limit the ability of financial advisors and mutual fund companies, asset managers, to provide investment advice to the investors who need it the most. And that's where we're working very closely with the industry and with the regulators to make sure that there aren't unintended consequences of the changes to regulations, and it allows us to improve the level and quality of advice that investors are receiving from financial advisors and from us.